Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz as we get across what happened on global markets on Friday. They fell heavily on concerns around the impact of the latest tariffs. While on Wall Street, weaker than expected US jobs data undermined investor confidence, sending stocks slumping, with the S&P logging its biggest daily loss in more than 2 months and the Nasdaq suffering its largest percentage drop since mid-April. For the week, the S&P was down around 2.3%, the Nasdaq declining just over 2%, and the Dow falling almost 3%. Also weighing on the equities was Amazon, with its shares sliding more than 8% after it failed to meet lofty expectations for its Amazon Web Services cloud computing unit. And Apple also proving to be a drag after it posted a current quarter revenue forecast above estimates, but Chief Executive Tim Cook warning US tariffs would add more than $1 billion in costs over the period. Among the oil majors reporting, ExxonMobil beating analyst estimates for second quarter profit as higher oil and gas output and lower production costs offset the impact of crude prices, and Chevron also beating second quarter profit forecasts on record oil and gas production and lower capex. Shares of social media platform Reddit surged after forecasting third quarter revenue above estimates, citing strong digital ad growth fueled by its AI-driven marketing tools. And this week, investors will be looking at the health of the broader US economy when results drop from Disney, McDonald's and Caterpillar. Shares of European pharmaceuticals slipped on Friday after President Trump sent letters to the major drug companies telling them to cut prices in the United States. Well, US employment growth was weaker than expected in July, with non-farm payrolls increasing by 73,000, while the previous month's job numbers were dramatically revised downwards to just 14,000, the fewest in nearly 5 years. The unemployment rate climbing to 4.2% in July as household employment declined, and domestic demand increased at its slowest pace in 2.5 years in the second quarter. And the ISM Manufacturing Index weakened further last month and remains in contraction. Now, in response to the data, FOMC member Neil Kashkari saying, "I'm not that surprised that the labour market is slowing. The data was worse than I had expected, but when tariffs go up, you expect prices to go up and the economy to slow, and we're seeing both of those effects." Well, US Treasury yields plummeted following that weaker jobs data, increasing the odds that the Fed will resume cutting interest rates at its September meeting. The 10-year yield falling to a 5-week low, down around 13 basis points to 4.2%, and the 2-year dropping around 25 basis points to 3.7%. And the US dollar registered its biggest daily loss against the yen since January 2023. The euro jumping almost 1.5%, and the Aussie trading at 64.7 US cents. Bitcoin has fallen back to around 114,000 US dollars. Oil prices tumbled on Friday at concerns about a possible increase in production by OPEC, while the US jobs data fueled worries about demand. Brent crude futures at $69 a barrel. Copper jumped around 2%, iron ore up 0.5% to $99 a tonne, and the gold price surged on expectations of a forthcoming rate cut, while the latest tariff announcements also boosted safe haven demand. Spot gold up 2% at $3,362 an ounce. Well, let's get across what's driving global markets with a focus particularly on the US. Greg Boland joining us from Tiger Brokers. Greg, happy Monday to you. As we look back on Friday, very much Wall Street driven by that non-farm payrolls report. What did you see? I mean, critically, it was that revision that really seemed to spook investors.
Yeah, it was the biggest revision downwards since 2013 in terms of the revisions. The farm payroll 73,000 added for July, and then the revised downward number of only 14,000 for June, a revision downwards of 133,000, which was pretty high. So with the May and the June numbers, a whopping 258,000 jobs down than prior thoughts.
Yeah. So what did you make of that? Sorry, I was just going to say, what do you make of the market response then? Obviously hitting equities, but also we saw those Treasury yields come off quite dramatically.
Yeah, so the indexes came off, dramatically as well, and also with the Treasuries coming off, the chances of a rate cut in September has jumped from about 30% to over 80% in one day. So what a difference 2 days makes after the Fed met last Wednesday their time, and by Friday they're all saying, well, we'll definitely be moving in September.
Yeah, unfortunate timing, you would think, for the Fed, given it came just a couple of days after their last policy announcement. No doubt Donald Trump is going to have something to say about that.
I think if they'd known those job numbers earlier, they probably would have cut last week.
Greg, also unnerving investors at the moment is the latest tariff regime as announced by Donald Trump on that August 1st deadline. What's the likely effect of that? It's still, the detail is lacking there.
Well, the economists are still saying that the tariff effective rate is around 16 to 18%, up from 2% under his previous presidency. So it's a huge change. I think we're only just seeing the first effects of it in terms of corporate earnings and all the old world companies, the 3Ms, the Johnson & Johnsons, and the like, all mentioning tariffs and the effect of tariffs in their reporting, and both GM and Ford, who are supposed to be benefiting from tariffs, saying that the costs are going to be somewhere between $3 and $5 billion over the next 6 months. So a huge change. And then they've brought in this huge tariff on imports from Canada, which has gone from 25 to 35%. New Zealand's been hit with 15% instead of what they thought would be 10%, in line with Australia, which probably reflects that more exports go to the US than imports come from the US and New Zealand. So and also the US Trade Representative Jamieson Greer stated that the new rates are largely fixed. So maybe we won't see the taco regime anymore, where Trump always changes his mind.
Greg, meanwhile, what are you seeing on the corporate front with those earnings continuing? What did you have your eye on last week?
Well, last week Meta was up 11% and Microsoft up 4%. And at the other side of the coin, Apple reported and fell 5% and Amazon around 8.3%. So you've got this sort of grouping of four at the top of the Batman stocks. You've got Broadcom, Meta, Microsoft, and Nvidia, which are all up over somewhere between 24 and 30% for the year to date. Then you've got this group in the middle of two, which is Amazon and Alphabet, which are more or less flat. And Amazon, most of that being flat is been caused by this latest reporting, when it dropped 8% on the day. And then you've got the group of two at the bottom, Apple down about 19% and Tesla down 25%. So you've got a grouping, sort of three groups in the Batman stocks at the moment, and I think that will continue.
This week, some notable reports: Disney, McDonald's, Caterpillar. Certainly, those last two be a good barometer of where the US economy is at right now, Greg.
Yes, I think so. I think they definitely Disney, McDonald's, Caterpillar, and Pfizer all reporting. They'll be interesting to see how they report in terms of their narrative on tariffs as well. And then you've got big tech reportings in terms of Palantir, which is the leading stock year to date in the S&P. It's up 104%. You've got AMD, Advanced Micro Devices, up 42% year to date. And Super Micro, but being a Kiwi, looking at Rocket Lab, they also report this week, and that stock is up 76% year to date. So a range of old world and tech stocks reporting this week, which will make it pretty interesting. And the E-mini futures, in terms of the S&P futures and the Nasdaq futures, are both flat at the moment.
Now, Greg, given we're near those record highs, what's your expectation, I guess, particularly with a focus on US stocks, given seasonality is at play at this time of year? August, September do tend to be weaker.
Yeah, that definitely, there used to be sell in May and go away. Well, that didn't happen this year because of the April fall, whereas traditionally from 1945, September's consistently been the worst month, usually down about 0.07% for the month, and August typically flat, whereas most of the other months of the year the market is up. So the Q3, because of the August and September effect, and also July, although it was quite a good month, I would see from a seasonal point of view no change in that ranking. That September and August, and I think are going to be quite difficult months, and the market swung very dramatically on Friday from being pretty bullish to being fairly bearish in terms of the technical signals. The VIX was around 15 earlier in the week, and it finished on Friday at to a high of 22%. And the equity only, the reading of 22%, my mistake. And then also equity only put call ratios have jumped to sort of 0.75 from 0.5. So the options market, which is the VIX and equity only put call ratios, are both showing a fairly bearish trend in the last part of last week.
Greg, great to get across what you are seeing on markets at the moment. Thanks for joining us from Tiger Brokers.
Thanks for having me.
Let's focus on the local market then. Of course, earnings season are getting underway here in Australia. But look, we are expecting a lower open, perhaps reflecting what we did see on global markets on Friday. So SPI futures off around 0.33%. Stay with us. We're going to get right across all that movement when we get going in just a couple of minutes' time.